If you're thinking about selling your home and you're wondering to yourself, what are the tax implications if I sell? Well, you're in the right place. In this video, I'm going to cover what taxes you have to pay when selling your home, but perhaps more importantly, how you can avoid paying taxes on up to $500,000 when you do decide to sell. The math isn't as straightforward as you may be thinking, so continue watching and I'll share my screen with you and I'll cover a few items. Some of those things are how to properly calculate the gain or perhaps even the loss you would have on your home. Something called Section 121, which is the IRS Code Section that discusses excluding the gain from a sale of your residence. So you don't have to pay income tax. What if your gain is over the exclusion amount? What to do then? How much tax will you have to pay in that situation? And what if for some reason you don't qualify for the exclusion? Don't worry, I'll still explain and show you what your taxes might be and what you might have to pay. And just how many times can you use the exclusion? Is there a limit based on your lifespan, or how does that work? All right, so make sure you stay tuned. Like I said earlier, the math behind this is probably not what you're thinking. So in a moment, I'll share my screen with you and go over an example of how this works. But let me first quickly introduce myself, especially if it's your first time watching. My name is Navi Miraj. I'm a CPA that teaches entrepreneurs how to save thousands of dollars in taxes. I do that here on social media, but I also teach it in an even more comprehensive and easy to understand manner through a course. You can find those details on my website, which is navimirajcpa.com. But for now, if you get value out of this video, just consider subscribing to the channel or perhaps liking it, sharing it with a fellow entrepreneur or someone looking to sell their home, okay? So let's start off with how to calculate the gain or loss. So let's have a look at this calculation here. So how this works is it's your selling price, right? The price at which your home sold for. In this example, I'm just saying $650,000, right? It's the sale price of your home minus your selling expenses. So selling expenses are defined by the IRS. The biggest one you're going to have likely is commissions paid to a salesperson, such as a real estate agent, as well as some of the legal fees involved. There might be other things, but this is what is the biggest chunk of your selling expenses. That will end up being what's called your amount realized. How much did you actually kind of receive and get in your pocket? So that's what they sort of mean by amount realized, okay? Then what you want to do is you want to calculate what your what's called adjusted basis is for your current home, okay? And so don't let that term adjusted basis mess with you. It is a tax term, but basically your adjusted basis is the purchase price. So how much did you pay for your home when you first purchased it? You are able to include in the adjusted basis some of your closing costs back when you purchased that home. You also get to add to your basis improvements, such as, let's say if you did a full kitchen remodel or a new roof or like a whole new HVAC system or something like that, that would be added to your basis as well, okay? So let's say you bought your home for $350,000 that is, and you had some closing costs and you did some improvements. So now your adjusted basis is $400,000. Well, now we can do the math. We have the amount realized minus your adjusted basis gets us in this particular situation at a gain calculated at the amount of $211,000 even. By the way, this calculation has nothing to do with the equity in your home, right? You'll notice there isn't anything in this calculation about what your mortgage balance is or anything like that. Some people seem to confuse the gain on the sale as the selling price minus their mortgage balance. Your mortgage or how much you owe, it's not relevant for this, right? They're irrelevant. So for purpose of calculating the gain on sale of home exclusion, don't bother messing with your mortgage or how much you owe or anything like that. It has nothing to do with it. Now, what are the exclusion amounts? Like I said, don't worry. Even if you don't qualify for the exclusion, I'll still show you how to calculate this. But real quick, this is kind of simple. If you're filing your tax return as a single person or married filing separately, it's $250,000. If you're filing as a married filing jointly, then it could be up to $500,000, all right? So how do you qualify for this exclusion? Because what I'm saying here is like, okay, you had a gain of $211,000, But even if you're single, you qualify to have all that $211,000 not be taxable to you. Okay, so you gotta pass two tests. These tests are called the ownership test and the use test. So let's just read these. They're pretty simple. If you own the home for at least 24 months, so 2 years, out of the last 5 years leading up to the date of sale, you meet the ownership requirement. If your tax filing status is married filing jointly, only one spouse has to meet their ownership requirement, okay? So you could have a home and you own that home for at least 2 years out of the last 5 years, and you could get married at some point in there. It doesn't matter. You pass the ownership test. The use test is the one that's a little bit more restrictive. Let's read what it says here. It says, if you own the home and used it as your residence for at least 24 months of the previous 5 years, you meet the residence requirement. The 24 months doesn't have to be consecutive. It just has to be 730 days during a 5-year period. Now, the next sentence says, if married filing jointly and trying to use the full $500,000 exclusion, both spouses must meet the use test requirement. You can even rent the home for a period of time during the 5 years and still qualify, okay? So it's 2 years, 24 months, 730 days, however you want to calculate it, out of the last 5 years. And you could rent at some period in between there. That doesn't matter. That won't exclude you, okay? I do want to make a quick note there. You see this note here? Things can get complicated real fast. So for example, what if your home was gifted to you? What if you're widowed? What if you had a job relocation? What if you had a health-related move? What if you had what the IRS calls an unforeseeable event? What if you use some of your home for business? It messes with this a little bit. So just know that there's literally what feels like an infinite number of scenarios. So this may be impacted if any of these things ring a bell, it could impact you, is basically what I'm trying to say here, okay? So how much tax would you owe? Well, if you look over here, tax liability, we said that the gain was $211,000, right? Right here, this is the same amount from over here that we calculated. Well, if you qualify for the Section 121 exclusion, then you don't have to worry about it. It's excluded, okay? The tax rate doesn't matter. It's not applicable. And the taxes you owe are $0 on the sale of your home, okay? But what if you don't qualify? What happens in that situation? Well, if you don't qualify, then it depends on how long you've been in that home, okay? So if you don't qualify and you've been in the home for 1 year or less, well, the tax treatment is as follows. You're going to be subject to what's called short-term capital gains tax. So I have the acronym here, STCG, in here for short. But really what that means is you're going to be taxed at the ordinary tax rates, which falls between 10 and 37% depending on your tax bracket, okay? So what I did is I just kind of put the 24% tax bracket, something here in the middle. And the math that's going on here behind the scenes is taking the $211,000, multiplying it by what your tax bracket might be of 24%, and I'm getting $50,640. So that's how much tax you might owe if you had a gain this large and you've only held that property for 1 year or less. Now that's going to be pretty rare, right? I mean, with the exception of what we had here recently in the past few years with this big real estate boom, you probably didn't have that much equity in the short period of time. Now, if you don't qualify for the exclusion, but you've held that property greater than a year, well, then you get another tax benefit. That is that you get your taxes are the long-term capital gains tax rates, okay? So these tax rates depend on your income. So it could be 0%, which is unlikely given the situation, 15%, which is what the average sort of person would have, and then 20%. So in our example here, I'm saying let's use the more favorable 15% tax rate, and the taxes owed are $31,650, right? So there's, in a way, some tax planning involved here. What if you were going to sell your home and you were in there just about, 11 months and a few days, right? Well, if you just wait a few more weeks, you can save yourself almost $20,000 in taxes. I think it's more like almost $19,000 in taxes. So a little bit of a tax strategy there, some tax planning to do when you are selling your home. Maybe the strategy is you lived there 1 year out of the past 5 years, Maybe you want to go in, live there another year, and save yourself a bunch of money in taxes, okay? Let me just show you one quick thing on my screen here and then go over some more of those questions that I said I was going to cover at the beginning of the video. I want to show you the tax brackets that may be applicable, just so you can kind of see what I was talking about a moment ago. So let me drag this over. So I just want to show you what I meant by the tax bracket. So these are the 2023 tax tables for single filers. So this is what I meant by depends on your tax bracket, right? 10% up to 37%, depending on your income. And then if you're married filing jointly, you notice that these tax brackets become a lot wider. Why I chose 24% is that, you know, I'm assuming your taxable income was within this range. But if you make more money, you got to pay more tax, okay? Sorry, not my rule, that's the IRS's rules. And then if married filing separately, you can see those tax brackets here. And there's tax brackets for head of household as well. Let me show you the capital gains tax rates, all right? I was saying like, hey, it's 0%, 15%, or 20%. Here's why it's like that way. Depending on your tax filing status and how much income you earn, the tax rate can vary. So that's why I just said, hey, if you're married and you know, this is your income, then 15% is a reasonable rate to use for our example. Okay, so what if your gain is higher than the exclusion amount, right? So, well, here's what happens. If your gain is over the exclusion amount, you'll just have to pay taxes on the amount over and above the exclusion I mentioned earlier, okay? So you'll pay likely long-term capital gains tax rates on the amount over and above the exclusion, okay? So let's say you had a gain of $750,000 and you're married filing jointly. So $500,000 of that gain is excluded. Well, then $250,000 would be subject to the long-term capital gains tax rates that you can see right here. So that's kind of how that would work, all right? Can you use the exclusion multiple times? Yeah, you can do that. You can use it multiple times. There isn't a rule that says you can only use the exclusion once. You just have to be mindful that you can't use the exclusion if you excluded the gain from the sale of another home during the 2-year period prior to the sale of your home. I know that's a bit of a mouthful. Basically, don't use the exclusion within 2 years of trying to use it again. That's an easier way to say that, okay? So I just wanted to create this video to explain to you what your tax implications are if you're gonna sell your home. In a moment here, if you're watching on YouTube, popping up soon will be another video I recommend based on the fact that you watched this one. Don't forget to like and subscribe, and I'll see you either in the course or in the next video.